Welcome, Nick Griffin from Munro Partners.
Thanks for having us, Drew.
A couple of quick questions at the Equities and Growth Asset Symposium. My first one is, what do you believe are the most important themes for equity investors over the next 5 years?
Yeah, so, I mean, obviously from our point of view, we're always looking for the big structural changes that are occurring in the world. The big one that we've been dealing with for a long time would be digitalisation of everything. And that continues. There's still significant more runway to go in digitalisation, whether it's e-commerce or digital payments or internet disruption. But the next big one that's coming along is clearly decarbonisation. Decarbonisation of the planet's going to be expensive. It's going to cost a lot of money, and you can quite frankly follow that money to find who will be the next big winners from decarbonisation.
Will that be bigger than digitisation or digitalisation?
Slightly different in the fact that digitalisation, the key thing that I think that we learned over the last 15 years, it turned into winner takes most.
Yeah.
So Google's worth 1.7 trillion, and they sold Yahoo this morning for the sixth time for $5 billion. So that's quite a large difference between number one and number two. That won't happen with climate. Tesla will have competitors in electric cars. It won't be the only car company. It's much more of a physical opportunity. So you won't get that winner takes most opportunity.
So maybe more old-fashioned businesses with assets.
Correct. Much more old-fashioned businesses with assets, building materials, air conditioning, insulation, wind turbines, you name it. Much more old-fashioned business that involve capital to spend and to grow.
And what is the most important trait you look for in a company with that in mind?
Yeah, so maybe coming back to what I said around winner takes most, but generally when we find these companies that win, they've always got a founding shareholder or highly aligned management. It's really that aligned management and customer perception that decides who wins. So when Google came along, there were 11 search engines. To the victor goes the spoils, $1.8 trillion today, and to the loser, zero.
And their market share is what, 98%?
Their market share is, over 90% in the US. And so from that point of view, it's winner takes most. And you've got to go with the guys who are 100% aligned on getting to that outcome, because anything that stops that will ultimately mean they end up being, a BlackBerry or an eBay or a Yahoo, et cetera, et cetera. And so from that point of view, that's what we look for the most.
And total addressable market or market share more important?
Definitely the size of the market is more important because that provides the optionality. So generally when you're investing, if they're the right guys targeting a big total addressable market, then they literally only need to get a little bit right for the stock to work. And so from that point of view, that optionality is what we look for in share prices when we're investing to try and get the valuation upside.
And the question of the day is, there's a lot of talk about valuations being high. Is this something investors or yourself are worried about or should be worried about?
Look, valuations are always topical. They're probably more topical now because they are high. I think the statement is correct. It won't actually change who wins and loses in the long run. All that you're seeing is investors realize that this asymmetric upside availability is out there, and they're pricing it into lots of stocks at the same time. Now we now know that lots of them won't get there, but they're doing it to get that asymmetric opportunity. And it just makes things a little bit harder, but it doesn't change how things end in the long run. And so our job is to really try and use our skills to find that one that we like, that one that we think will be that winner takes most, and to invest in it and ride it for long periods of time. And then obviously blend that with other ideas in the physical world, like I talked about in climate and stuff, where you can actually look at more boring business with much more valuation support.
So it doesn't have to crash. Earnings can catch up instead.
For many of these stocks, yes, earnings can catch up instead, and we're definitely seeing that today. If you look across Amazon, Google, or Uber, or any of these companies, even the software companies, the earnings are catching up. It's also important to flag, these little bubbles have been popping for a while now. Whether it's, marijuana or EVs or SPACs, they are all actually popping. And so it isn't like the whole market's in a bubble. It's just there are pockets of speculation, and it's understandable for this time in the cycle.
And maybe an early insight into what stock you'll be pitching this afternoon?
I.e. the name of the stock?
Yeah, I guess so, yeah.
Yeah, so look, from our point of view, disruption continues, digitalization continues, and Amazon is our number one stock of all time. We've owned it in the fund since 2013 to today, and we're always looking for the next ones and the next ones that come along. We see a burgeoning crop of emerging champions right now, and the one we're going to be talking about is in e-commerce, and that company is HelloFresh. We see it disrupting a large grocery opportunity in e-commerce, which is the large, big piece of e-commerce that hasn't been disrupted yet. And it's exactly what I was just talking about. It's a very small company with a lot of optionality to the upside and a management team that are highly aligned on getting that. And so it ticks really all our boxes right now, and we think there's potential for it to be a really big champion in the future.
Thank you, Nick.
Thanks very much, Drew.